Joining us here at Post 9 this morning, Lori Calvasina, RBC Capital Markets head of U.S. equity strategy, target of 42.50. It's great to have you back. I think most what you've been writing about lately is that the energy trade still has some runway.
We think so. And, a couple weeks ago, the trading community, even my commodity strategists, they were starting to kind of say, look, maybe things have moved too far, too fast. And I'm very sympathetic with that from an oil price perspective. But looking at my models on earnings revisions and valuations, they looked, still valuations deeply attractive and earnings revisions kind of early stages of a recovery. And so we just looked at it and said, look, if the oil price cooperates and hangs in there, there's plenty of room to run from our perspective. Plus, I think the growth trade still needs to correct, and that money's got to go somewhere, and that outperformance has to end up somewhere.
So fundamentally, it's still a supply story as opposed to demand?
What Mike has been saying, our energy strategist, is that the fundamentals of the oil market are some of the best that he's seen in a while. It just felt like maybe from a sentiment perspective, things had gotten a little bit ahead of themselves.
Let's talk about other parts of the market. I mean, we've talked endlessly about the mega caps and their outperformance, certainly versus the NASDAQ, let alone the S&P. What about small caps and where things stand right now, given their underperformance this year?
I'm a glutton for punishment, right? Because this is, area I used to cover exclusively. And I look at all my models. I mean, the valuations are so deeply compelling. It's not just financials. Pretty much every sector is cheap and small relative to large. Earnings revisions are starting to improve in small cap. We're finally starting to get some positive revisions. Everything is working on the data. Even the funds flows have improved just a little bit. But we still can't seem to get that outperformance trade going. And I think the problem is that there's still enough doubts about the recession, about whether or not we're actually going to get it. I think as you see confidence grow that we're really skipping it, that it's not just delayed, I think that should help. And I also think, frankly, you need to get a little bit closer to Fed cuts. Traditionally, small caps do very well after the Fed starts to cut. I'm wondering if we're going to start to see people talk about that in December, maybe November, and maybe see some pre-positioning around it. But right now, second half of 2024 still seems a little far off.
Yeah. All right, so soft landing confirmed and or even cuts, and then finally small caps might outperform.
I think so. I mean, you're not as cheap and small relative to large as you were back in the tech bubble, but we're down around the lows that have been holding the last 5 or 6 years, and those lows don't seem to be breaking. So I think small caps are kind of drawing a line in the sand. They're fighting back, and that resilience needs to be respected. So I wouldn't short them by any stretch.
We had Yellen on a couple of moments ago and sort of went through the catalog of potential potholes, whether student loans or energy prices or the strike. I mean, how do you frame those in your overall macro setup, which appears to be pretty constructive?
Yeah, I mean, look, we sort of feel neutral tactically. We think it's a little too early on 2024, but we're not in the bear camp by any stretch. I have been, a little more tactically cautious in the short term, and frankly, that hasn't worked. The market's been more resilient the last month or so than I'd anticipated, but I do worry that, we're getting this student lending issue at the same time that gas prices are starting to spike. This is a lot to pile on the consumer. Excess savings, we're hearing a lot about that from the economics community being worked down. I do push back on that just a little bit. We've been pointing out that if you look at homeowners, they're still benefiting from the era of low interest rates. The interest rate on mortgage debt outstanding at the end of 2Q was still only 3.6%. So there's, I think, buffers that aren't entirely being appreciated. But there are, a lot of potholes coming up.
Well, to the extent, though, that you underappreciated or underestimated the resiliency of the market, what was it that specifically perhaps you've revised your own thinking on, if you have?
Well, so I'll tell you, we do a weekly, and we put out this big deck every Monday, pretty much every Monday, and we go through all this high-frequency stuff that we track. And the thing that really surprised me last week was to see that U.S. equity inflows were picking up again and strengthening, and it was the growth part of the market. And I didn't expect that this late in the year. And where we saw the weakness, it wasn't money going bond to equities. That's what all the bears would have anticipated. But it's actually the money flows are starting to soften on Japan, China, and emerging markets. So it's a U.S., non-U.S. dynamic that's suddenly starting to help us. I talked to my economists last week, and they were saying one of the things they're really starting to think about is the idea that the U.S. is just sort of this fundamental, kind of island, this oasis, and that our fundamentals look a little bit better here than the rest of the world. And I think that's a big shock to global investors who are very negative on the U.S. to start the year from an economic perspective.